All right. Well, good morning, everyone. Welcome to AllGen's quarterly update and market review for the first quarter of 2024. Happy New Year. Is it? Oh, I'm hoping it's still okay to say that on January 18th. Okay, but today's January 18th, 2024. And as you may know or are about to find out, AllGen does these quarterly webinars to kind of give our community, our clients, our our friends a sense of what we're thinking as far as the economy, the markets, and any financial planning updates that may still be relevant to you. So today, we're going to we always start off with some fun, get you guys engaged, and give some, the latecomers a chance to get in. So we'll start with some questions, usually a fun one and a not, I wasn't saying not so fun one, but they're both fun, just one's more market related than the other. Then we'll have Jason go through his spiel about the market review and the outlook. After that, we'll give some AllGen updates and financial planning updates, and then we will answer questions at the end that you may have. Okay, so in order to do that, there'll be a place where you can put questions at the bottom. If you see here, it'll be recorded. So if you miss anything or have to leave early, everyone who enroll in our clients will get a copy of the webinar, an audio copy of the webinar sent to them. Okay. Well, also not just audio, it's visual because the slides are present. Okay. But aside from that, while you're here, please feel free to type any questions, thoughts, comments that you have in the Q&A box at the bottom. The raise your hand is X'd out, but you can still go into the Q&A and ask a question. Okay. So speaking of questions, let's go ahead and start with a question. And first fun question is, who do you think will win the Super Bowl? It's that time of year, folks. So there's been some surprises, excuse me, as far as some games in the first round. So who do you think will win? Taylor Swift's team, aka Kansas City, the Tampa Bay Bucks, the Buffalo Bills, Detroit Lions, the Houston Texans, Baltimore Ravens, San Francisco 49ers, or Green Bay Packers. There is a right answer, but you won't be judged based on the answers because these are kept private. So please feel free to answer if you have an opinion. I guess we should have put, I have no idea, but we're going to just speak to people who have a conviction. So let's go ahead and give you a second to answer those because I know it's a lot of choices. And then we'll see what the final answers say. And let's see. Oh, look at this. It looks like Taylor Swift is having an amazing impact on the expectations. Most people feel that Kansas City is going to win with San Francisco coming in second place. All right. We'll see how that goes. So next question, a little bit more markets related, okay, is, this year's an election year. So we always like to ask this question. We'll touch upon this in the presentation as well. But how do you feel about the upcoming election's potential impact on the markets? What do you think this election year will do to the markets? A, I'm ready just to move to Costa Rica. Just get me out of here. Okay. B, I'm nervous because I think the markets will go down. C, I'm unsure what to expect. Or last answer, I'm feeling fine because I don't think it will have an effect on the market. So I'll give you a second to let that brew over. Some people have already brought immediate questions about this during the beginning of the year. Some people are not sure, but that's okay. We'll give you a second to answer that question. All right, let's see how participants are feeling. I'm ready to move to Costa Rica. All right, that's actually the second place, but first place, I'm unsure what to expect. Fair enough. We appreciate the honesty, and I'm sure most people aren't sure what to expect, but that's okay. A couple people want to go to Costa Rica, and I'm feeling fine because I don't think it'll have effect. Very good. Well, thank you for participating. That also helps us know how to handle our people or have conversations with our people when we do financial reviews and planning reviews with our clients. So that being said, again, please remember we're gonna be fielding questions at the end, but feel free to put them in there as we go. And that being said, again, Jason, take it away.
All right. Well, hello, everyone. Let's jump in here straight away, and we'll get into kind of how the markets did last year. A little quick review before we jump into kind of what we're looking at as we go into 2024. So as you can see on this screen, markets actually ended up pretty strong. S&P, which is the S&P 500, which is the large U.S. companies, were up 24%. The S&P 600, which is small U.S. companies, ended up 17%. International was up 16%. And then the bond market actually ended up 6%, but that doesn't tell the full picture. So I go to this next slide here. The first slide we were just looking at is this section on the left. All right. And I want to particularly point out to this vertical line right here, which is around late October, where the markets were taking a pretty big dip. And for the most part, actually, there were two indices that were down. Small caps were down 5%, bonds were down 3%. International was pretty much flat, and the S&P was still up 9 at that point. But a conservative portfolio, and even the benchmark for a conservative portfolio, would have been negative at that time. And that's coming off of a 2022, which was negative for everyone. And what that caused a lot of people do is you kind of have a little bit of recency bias coming from 2022 as we go into 2023. No one liked 2022. That was a very difficult year for markets, and especially for bonds. It was the worst year of all time in the U.S. history for bonds. And then you go back into 2023, things are starting to look a little bit better at the beginning of the year. Things start to go up, and then you have this big drop right around October. And the point I'm trying to make here is a lot of people got pretty concerned at this time, and we've actually fielded way more questions than we normally would about making the shift to money markets and making the shift out of the market and going into cash at that time. And, investing especially with helping our clients, is really twofold. We're going to do the best job we can and put in a lot of work of trying to do the best in terms of portfolio performance and managing risk really well. But at the same time, we're in a partnership with our clients, and our clients and just people in general are emotional. We're emotional beings. It's how we're wired. And we have this fight or flight mentality. And so what can happen when you have this big dip, especially after coming off of a really bad year in 2022, people can get concerned and sell out of the market. And we talked to a few people off the ledge at that time. But what I want to highlight here is usually markets do really well right after the worst of times. So this highlighted box here on the right shows you what happened to markets right from that bottom point. So from that bottom point, you had small caps up 22%. This isn't a period of just over 2 months. Up 22%, S&P up 15%, international up 14%, and even bonds, in a matter of a little over 2 months, were up 8%. So that's why it's so crucial to stay invested during the difficult times. There's a lot of studies that will show, over time. One kind of pretty famous one is called the Dalbar study, which talks about, how the markets do over time, just general indices versus the average investor. And the average investor, a lot of times, instead of doing what they're supposed to do of buying low and selling high, they end up doing the opposite, buying high when markets are going up because everyone's excited about the market. That's when you tend to buy. But then when things get scary, people sell when they're down. And on average, that study shows through the given years that the average investor underperforms anywhere. I've seen as low as 3%, as high as 6%, over the years, that the average investor underperforms, and mainly because they're selling when things go down and they're buying after things go up. So this is a little bit of a technical chart, but this reinforces that point. And this is a chart that we showed in our last quarterly webinar. And I'm just pointing back at that same point on this last slide, this low right here when the markets were down. This was what the panic/euphoria model was showing. Really quick review of that. It's measuring basically people's sentiment. When people are panicking, the line is going down. When people are euphoric or happy about the markets, this line would go up. So when the line's above the red line, that's when people are very excited. Those are usually when markets are going up like that. But then when markets go down like 2022 and like that October low of last year, you had a big rise in people's fear levels and people panicking. And historically, when that happens, and we made this point, the next 1 year returns are 17% on average, and the market's up 94% on average most of the time. So all that to say is just to help our clients try to stay invested during the worst of times, because usually that's when you get the best returns right after the biggest drops. One other point to kind of show this is total fund flows. So this is money coming, and this measures money coming into the market and actually into mutual funds, exchange traded funds, versus money coming out of those funds, like selling. And so when the line goes down below zero, that's when people are selling. When the line is up, that's when people are are buying into funds. And so for pretty much all of 2022 and all of 2023, on average, people were selling during that time. Again, selling when markets are down. And so, it's just really important that, and we try to build portfolios to really manage risk well so that it can help our clients get through these difficult times where emotions can really start to drive behavior. And if we're able to kind of help educate our clients and teach them to be able to manage those emotions, they're going to end up with longer term returns over time by not selling when things are down, because it's very difficult to get back in the market. Everyone thinks they're going to be able to get back in the market right at the right time, but what almost always happens is the market goes up a lot before they get back into the market, and which means they miss out on a lot. One final, before I beat this dead horse here, but one final point is that this just shows, over time, if someone is to, on average, if people stay fully invested, their returns are 9.4%. So this goes the 20-year period from 2002 to 2022, but these are similar if we even go back further than that. So on average, returns are 9.4%. That's for the S&P 500. If you miss the best 10 days of the whole entire 20-year period, you're only making 5.21%. If you miss the best 20 days, you only make 2.5%. If you miss the best 30 days, you're basically flat. That's over a 20-year period. And this is a very important point. This is a great chart put out by FactSet. But 7 of the 10 best days on record occurred within 15 days of the worst 10 days of the market. So the point of that is when things get really bad, that's when people sell, but then they end up missing out on when times are really good. You almost always get those really good times right after those really bad times. So shifting gears, looking into, as we move into 2024, one thing to keep an eye on, or that we're keeping an eye on, is that money market balances have gone up a lot. So you can see this is retail money market fund balances. This is just retail. We could actually show the institutional side as well as a very similar chart, but just retail, non-institutional investors have put 1.7 trillion or have 1.7 trillion in money markets right now. And you can see this massive spike. Part of that is because interest rates have gone up and you can get a good yield on money markets. But the point I'm trying to make here is that typically when this happens, when you get really high money markets, it provides long-term fuel for the market. So all this money, and a lot of times what happens is people sell out. If I showed you, remember looking at that money flow chart, fund flow chart, where money's coming out of, stock and bond funds, it's going into these retail money market funds. Well, as markets start to look better, and what happened at the end of last year when markets were up some 15 or 20% in a couple month period, people will then use the money in their money market fund and say, hey, I'm missing out on the market. Let me jump in. Let me sell my money market fund to go and get into the market. So this is potential fuel for the fire, meaning potential fuel that could drive a bull market further. So I would put this on the side of this. It kind of paints a bullish scenario for the market, at least having a good amount of cash to continue to kind of push the markets higher for a longer period of time. So that's one thing we're keeping an eye on. Another thing to really point out, it was a very interesting year last year, and this is going to get a little bit technical, but I'm using this as a point to kind of reinforce the benefit of being well diversified. Okay, so the S&P 500, which is the largest 500 U.S. stocks, okay, is what's called market cap weighted. So market cap weighted means every company that's in it's basically the size of the company. So if a company becomes really big, it has a very big market cap. Well, what happens is people may have heard the term Magnificent Seven. No, that's not a Marvel movie. It's pointing out Microsoft and Meta and Google and Nvidia and Tesla, the kind of big stocks that really drove a lot of the returns really over the last 5 or 10 years, but especially last year. So if you have a market cap weighted index and that Magnificent Seven they become really big stocks, which they are, they're the top 7 holdings essentially in the S&P 500, and the S&P 500 is made up. Almost a third of the S&P 500 is in those 7 stocks. So that is driving a lot of the returns right now, is that kind of those really popular names. And so, but if you contrast that to what's called an equal weighted index of the S&P 500, so say same 500 stocks, but they have an equal weighting for each one of the 500 stocks, that only returned 14% last year versus 24%. Still good, but not nearly as 10%. It underperformed by 10% compared to the S&P 500. And as you can see, that October low I was pointing out at the beginning of the presentation, it was actually negative. It was down almost 3% when the market was going down. So when it was going down in October. But the point I'm trying to make here is this particular year, and there has been times in history like the late 90s, which I'll point out in this next slide, where owning those popular names and having a higher weighting in those names can really get you good returns. But if we look here at this next slide, if we take the S&P 500 equal weighted index versus the regular S&P 500, which is the orange line, and we go all the way back to 1995, you can see that the equal weighted index significantly outperformed by almost 300 percentage points over the long term. But if you look here, and it's a little bit skewed, if we could zoom in on this, you could paint the picture a little bit more. Right here, the market was, or the regular S&P in the late 90s, when you had kind of that dot-com bubble and all those technology stocks were doing really well, kind of similar to the last few years where technology stocks did really well. You can see here that the S&P 500 was up about 100%, where the equal weight was up only about 60 during that 5-year period right there. So the popular stocks did a lot better. However, look at what happened over the next almost 6 or 7 years from 2000 to 2007. You can see that the purple line, which is the equal weighted, the more diversified index, which is what the way we try to keep our portfolios, did significantly better, and even went from a significant underperformance to a significant outperformance during that time. So I make this point to say, sometimes it's tempting to want to hold those really sexy names that you hear in the news, and be a part of that kind of whether it's the dot-com bubble or part of the AI or blockchain or whatever that kind of the new technology is. The scary thing or the risky thing about doing that is that when you do that, you tend to do it after the big move. Like if we're looking back here, after these have already significantly outperformed, which puts you at a higher level of risk going forward. So while being more diversified at times may mean you underperform, it makes more sense over the long run because you tend to take less really big drops, and really over the long run you also can over time, at least historically, being better diversified has led to better returns, as you can see here in the equal weight S&P versus the regular S&P. So as we move on, looking at the chart now from looking at the S&P 500 from a technical standpoint, this is looking at the last 3 or 4 years here. You can see the big drop in 2022. And then you kind of have the recovery as you go into 2023 and 2024. We're now up towards the all-time high. So the market made an all-time high at the end of 2021 and beginning of 2022, right over here. And you can see we're right up against this line right now. So from a technical standpoint, that usually will act as resistance. Think of resistance as a ceiling. But at the same time, if you're able to break above that ceiling, then you don't have any other all-time highs, meaning there's no more resistance. It creates kind of a line of least resistance for the market to continue to go higher if you'll break out above that. So that's an area that we're watching very closely to see if the market could break above that. So far, we're still in an uptrend from the low of October of 2022. The market's having a little bit of a difficult time breaking through that resistance, but that's something we're going to be watching very closely as we go forward into 2024. Now, looking at the market from a valuation perspective, there's really kind of the area that's done really well over the last 10 years is this S&P 500 growth. So your large growth companies. But if we look at the current PE ratio, is close to 33. The future price to earnings ratio, so basically what it's projected to be, it's taking the price of right now versus what the projected earnings will be over the next 12 months. And you can see here, those return, or excuse me, that valuation is at 26. But then you look at small caps, and at the large value companies, and all of those are significantly lower than what the large cap growth is. So the large cap growth names, have done really well. There are some really good companies in there. We hold some of those companies, and we hope they continue to go further higher. But they're taking a little bit more risk now, quite a bit more risk, because their valuations are significantly higher. From a valuation perspective, there is much better value than in small caps, which is the S&P 600, and the large cap value stocks. So valuations are one way to look at it. This is one way to look at valuations of companies. Another way to look at it is, okay, well, what is the forecasted earnings growth? Like, how fast are these companies supposed to grow going forward? The fastest growing companies going forward on average for this year, the earnings growth for the S&P 600 small cap growth companies is around 27%. So those are projected to grow fastest this year in terms of their earnings. Large cap growth is still, which is the area that's a little bit overvalued right now. It is still projected to grow at a pretty good clip of a little over 16. And then you have the S&P 500 value at around 14, and then small cap value around 8. So that's something to keep in mind. Well, you can justify a higher PE ratio if the companies are growing at a faster rate. Well, there's a very cool ratio that kind of looks at the difference between what is the valuation versus what is the growth, and that's what's called a PEG ratio. So you're taking your price to earnings divided by the earnings growth. Bottom line here, there's a number of ways, kind of like from a textbook standpoint, under 2 still is a decent value when you get above 2. And that's all the gray lines that we're looking at right here. When you get above 2, you're starting to become very overvalued. The closer you get to 0, the better value there is right now. So from a PEG ratio standpoint, the best value is in small cap growth. The most expensive is that large cap growth, which from a PEG ratio standpoint is significantly higher, almost 3 times higher as what the small cap growth is. So all that to say, small cap has really underperformed over the last few years. It was the best performing in the last 2 months of last year. It's an area that we're evaluating where it may make sense to increase a little bit in this area as we go forward, at least from a valuation perspective, which can never pinpoint when the market is going to change and money starts flowing more into those stocks. But odds are over time, with the better valuation areas of the market tend to have better longer term performance going forward. Never guarantee, never know the future. So as we flip from kind of domestic valuations of what we were just looking at now to kind of more international and comparing that to the US, to start with in the US, the forward PE ratio for the whole S&P 500 is 19.5. So all these blue diamonds right here are where the current PE ratio, the forward PE ratio is, versus the purple horizontal bar, is the 25-year average. And then the gray is just the range over time in each one of these areas. So when the bottom line, when the blue diamond is above the purple line here, that shows you it is overvalued compared to its historical average. So it would show that the US is overvalued compared to its historical. However, Japan and Europe and China are significantly undervalued, and emerging markets are right at their valuation compared to their historical average. So from a valuation standpoint, as you look at Japan, you look at Europe, and some components of the emerging markets, you have better valuations. Does that mean that area is going to outperform going forward? It doesn't always mean that. However, odds point to at some point these will revert back to the mean, which means the US will kind of revert back to its average, and international will revert back to its average. The US kind of having to either come down and international coming back up. So another reason to stay diversified, because you never know when that's going to happen. But odds favor at some point in the near future that could happen. All right, Well, something that also plays into kind of a lot of things that we do is really following the direction of the dollar, of the US dollar. Has a big impact of kind of money flows around the world. When the dollar is strong, money tends to flow into the US. And then when the dollar is weak, it can go to international and gold, emerging markets, other areas. So if we look at the last 10 years, you hear a lot of talk in the just kind of media or commercials, and I even heard a country music song last year talking about how the dollar is going down significantly. And I won't use the slang terms that people talk about, but in the country music song, if you know what I'm referencing. But this particular chart over time is a very solid uptrend. And that has been the case for over the last 10 years. So the dollar still looks to be in a solid kind of long-term uptrend. Another thing that really causes the dollar to go up or down is the direction of U.S. interest rates. So when U.S. interest rates rise, and this is true for a lot of countries, when your currency or when your country's interest rates rise, it drives money to your country. So in the U.S.'s circumstance, when the U.S. interest rates went up as we went into 2022 and kind of peaked so far in 2023, the dollar went up significantly. And then now, as it looks like the interest rates are starting to peak and could potentially come down this year, the dollar has started to decline, anticipating that interest rates will eventually come down. So far, the market, I mean, the dollar has still held up, but this is something we're watching over time, because as the dollar goes down, that's when international stocks look more attractive. That's when the dollar looks more attractive. So this is something that we're closely monitoring along with interest rates. And this chart kind of proves this point. So looking at international last year, you can see the gray line is the international stocks and the blue line is the dollar. And especially towards the end of the year when the dollar started to decline, you see international stocks went up significantly. So those kind of are inversely related. And so and it's the same thing with gold, which I'll show you in another chart. But this only goes through the end of 2023, the dollar has actually bounced a little bit as we see this chart. It's bounced a little bit as we go into this year. And so something to monitor. Now, just looking at a component of international markets, you can see emerging markets. There's been a lot of problems in terms of international trade, geopolitical relationships with China. And so you can see China has really suffered from that. They're down 12%. But there are other areas of emerging markets like Mexico and India who have performed really well. Mexico had a 40% return last year as measured by the Mexican ETF, the iShares Mexican ETF. So, you sometimes, emerging markets are clumped into one emerging market index. And that was only up 9%, which didn't perform super well compared to the other indices last year. However, there are some components of emerging markets that have performed well and look potentially attractive as we go into this year of 2024. So again, back to the dollar and its effects now on other areas outside of international. This is looking at gold. And so gold had a strong year last year. It was up 15%. You can see it really rallied in that last quarter of the year as the dollar went down, the blue line, and the gray line is gold. So this is an area that too where, especially in difficult times, and if the dollar does decline as interest rates go down, gold is a good diversifier, and it tends to do well in those scenarios, especially as interest rates go down. So that's something we're watching closely too as we go into next year. Now, looking at kind of macroeconomic standpoint, this looks at inflation, and this was one of the big reasons why the Federal Reserve had to raise interest rates a lot. You can see after the pandemic, when the U.S. started to really stimulate the economy by bringing interest rates down to zero, doing quantitative easing, printing money, and also sending people just direct stimulus checks, you can see inflation really started to go up after that. And that peaked kind of mid-year of 2022. But now you can see that it has started to come down as we go into 2024, and went down a lot last year in 2023. However, the Fed's looking for this to get to 2%. So we're still not at that 2% target, and we're still up at kind of the around the 3%, and core is just under 3. So, and you can also see that this has flattened out a little bit right here and is not coming down at the pace it was coming down at. So that's something to monitor. And if you continue to have that, where where inflation stays above that target, the Fed is going to be less likely to lower interest rates. Now, there's other measurements of inflation like the producer price index, the PPI, which has actually gone all the way down to 0, not as much of the overall economy, but it could be pointing to potentially that inflation could get to that target. But that's something to monitor. If inflation doesn't continue to get, even though it's gotten a lot better, if it doesn't get below that 2% target, it's going to be less likely that the Fed does lower rates. And so, with the big drivers that we pointed out a lot, and I've showed this chart over the last year because it's an important one to monitor, is that the big driver of inflation is what's called wage inflation. When people get paid more, they tend to spend more. And what causes wage inflation is a tight labor market. And right now we have a very tight labor market still. So you still see the dark blue line, which is job openings, also called JOLTS. You have 8.7 million job openings, but unemployed of 6.2 million. So basically 6.2 million people looking for jobs, 8.7 million open jobs. There's a lot more openings than there are people looking for jobs, which means employers still have to try to pay attractive wages to attract new employees. And that continues to keep inflation higher. It also keeps the consumer pretty strong. So another thing, so that's one big one, is the labor market to watch. And the other kind of big component of the CPI or inflation is housing. And housing, this is looking at what's called owner's equivalent rent. So basically, if you were to rent out your house, what price could you get for it? And this measures kind of year over year, what price could you get for it now versus where we were a year ago. And this got up to a very high rate of an 8% increase year over year, kind of towards the end of 2022, beginning of 2023, but has started to come down, still has the ways to go before it kind of gets to that long-term average of around 3.5. But it's at 6.4 and it is heading in the right direction, but it still has a ways to go. So that's something we're going to also watch, and that will reflect into the inflation numbers, which again drives the Fed's decision making. And the market is very much dependent on what the Fed does. So that's why we stress this point of kind of trying to understand where the Fed's going. There's a really interesting chart put out by JP Morgan that is a little bit complex, but if you stick with me here, it does tell a very interesting picture. So if you look here at the personal savings rate, which is this dark blue line, so pre-pandemic, Americans usually save on average 1%, 1.5%, which is actually very low compared to the rest of the world. But that's how we are as Americans. We spend a lot of money. But you can see that really spiked in the pandemic because you had a bunch of stimulus checks. And even though a lot of people lost their job, most people didn't lose their job, and they got all these stimulus packages. So their personal savings rate got as high as an average of 6, which is very high for America. And then you see another set of stimulus came out, and stimulus checks came out at the end of 2020, kind of beginning 2021. And that spiked again, a lot more cash coming in. So this light shaded blue area shows the excess savings. So the amount of kind of excess savings that are in people's savings account that happened because of these stimulus checks that people received, and in the pandemic not being able to travel and go out, that you had a lot of savings built up, which is what's keeping the consumer very strong. However, as we kind of transitioned into 2022 and 2023, all that stimulus went away. And so now the personal savings rate is much lower. And you can see people are starting to kind of drain through or go through that excess cash. And what was at a peak of 2.3 trillion in excess savings, now we only have about 1 trillion in excess savings. So we still have a little bit of excess savings, which can kind of push us through over the next year. With interest rates being higher and no more stimulus, that's caused a lot of people that when they did buy a lot of things, whether it's a new house, new car, or they took out a home equity line, over here, now as interest rates have come up higher and people are having to make student loan payments, they didn't have to make that back during the pandemic either. It's causing people to drain through cash and now have a negative monthly cash flow in their personal budgets. So they're draining through that cash. That can cause a problem over time. And so that brings us to this next chart where we look into delinquencies. So flows into early delinquencies. A delinquency is when people don't pay their credit card or their car loan. So that's really what I want to focus on here because student loans are a little bit of an anomaly. I'll explain a little bit. But so auto loans right now, you have a delinquency rate of 7.4%, which means out of all the auto loans outstanding, 7.4%, people are unable to make those payments and they're delinquent. Same thing with credit cards. That's now up to 8%, which if you kind of follow these peaks over, that's the highest on both of these since the financial crisis. And you can see it got up extremely high in the financial crisis. So that's an early warning sign of a consumer that may be starting to feel the higher interest rates, which could cause problems. While we still do have some excess cash, as I pointed out right here, it could cause some problems as we continue to go through 2024. Now, I do anticipate student loan delinquencies will start to spike as well. You had a time period for almost 3 years where people didn't have to pay on their student loans. And even though that started in September of October of last year, you had the option to delay it one more year. So I do think you'll also start to see student loan delinquencies rise as we kind of get through that period where people don't have to pay. So all that to say, that is a warning sign. I put that on the side of, this could be a difficult market as we kind of get through and the consumer goes into a more difficult position. Right now, they're fine, but there were some early warning signs that they could kind of struggle going forward. All right, so transitioning into what does this all mean? So thinking through all the different inflation numbers and kind of where the economy's at, the market is so dependent in looking at kind of what the Fed's doing. And so this chart right here shows what the federal funds rate is. The FOMC, or the Federal Open Market Committee, determines where short-term lending rates are. And so in a lot of kind of loans, money market rates, car loans, house loans, all that is dependent on these interest rates. As interest rates go up, all those other rates go up, taking money out of the economy, making it destimulative, making it more expensive to borrow. But then as rates come down, money gets cheaper. It stimulates the economy because it's cheaper to borrow. People could buy more house, more cars. So that's why the market follows this very closely. And we're up at a highest level we've been in over 20 years. But it looks like we did peak kind of around July of last year. Now we have two different dashed lines going forward as we go forward here. You have the market expectations, which is kind of put forth by kind of futures rates and where the market anticipates interest rates going. And then you have the Federal Open Market Committee, the Fed, what they project. And there's a very large discrepancy right now between those two. So as we end this is the ending point of 2024, the market anticipates will be down at 3.6%, which is a pretty large cut. It's over a 1.5% cut from where we are right now in interest rates. And that's why the market started to turn around and go up at the end of last year, because it was, some numbers were showing that inflation was coming down significantly. Maybe the jobs picture was starting to get a little bit better in terms of not being so tight. And so the market was projecting that interest rates would come down really fast. The market likes that because it's stimulative. And so you got to think that the market always anticipates the future. So as interest rates come down, that's a good thing for the market, and markets tend to go up in that anticipation. Okay, but the problem is that sets an expectation where they're expecting interest rates to be down here at this 3.6% rate. But the Fed says, no, not so fast. We don't see inflation coming down at that pace. We're still got some issues. We only see it coming down to 4.6. In both scenarios, it does show interest rates have peaked and are coming down. That's a major difference. It's a 1% difference in expectations of the market versus what the Fed's saying. So we kind of think it's going to be somewhat in the middle of these two. But the problem is if it does fall somewhat in the middle, then and this you started seeing this a little bit at the beginning of the year, bonds could potentially take a little bit of a hit after they've rallied so much over the last couple of months in anticipation of what the market's thinking. If it doesn't get what the market's thinking or where the expectations are, if that falls short, then bonds may struggle a little bit until we find this equilibrium. They may be a little bit more volatile. The good news with bonds, though, is they're paying much higher interest rates now. So it's not like when we were back here, in 2020 and even kind of pre 2017 when interest rates are at 0, 1%, and a 10-year Treasury bond pays 1.5%. Now 10-year Treasury bonds are paying over 4%. Some corporate bonds are paying over 5%. So even if you have a little bit of volatility in the bonds, you still are getting paid a much higher interest rates. But at the same time, in both scenarios, it does show interest rates coming down. And remember, the price of bonds tend to go up as interest rates goes down. So this chart reinforces this. As interest rates went down at the end of last year, the aggregate bond index, or the price of bonds, went up. So that could paint a pretty good long-term picture. If interest rates are to continue to come down and the economy was to slow down and inflation was to come down, then that could be very good for bonds. And we do like bonds, especially now after a big drop, because they do pay a higher yield and they have much better potential going forward. So this is kind of where the bond market, the different areas ended last year. What did best was high yield, which is a little bit risky now as you go into high yield is also called junk bonds, but those tend to be the corporations that have a lower credit rating. And so if interest rates, or since interest rates are high, when they go to roll over their bonds, they're having to pay much higher interest rates. That's attractive to investors and typically does well when markets do well. But if markets get shaky and they start to come down and you have more delinquencies, that can be an area that can get hit hard. Emerging market bonds did 9.1. You could say just regular corporate bonds is 8.5. Corporate bonds in general tend to do well with the market. Money markets did 5.1. And then you can see the longer term bonds did 2.8. Longer-term bonds are still down over 40% from their high in late 2021. And so as interest rates come down, which remember they were going up last year, but as interest rates come down, the areas that will tend to do best are usually historically longer-term bonds will tend to do better as interest rates come down. Those are the most interest rate sensitive. Doesn't always happen that way, and it'll get technical for me to explain in this presentation. But usually those are more interest rate sensitive. So again, as interest rates come down, that could be an attractive area. This is an area that we've started to build a larger position at last year. And just in general, bonds are looking much more attractive after a very, very difficult, one of the worst times, or the worst time in U.S. history, 2021 and 2022, and even partly through 2023. And pretty much all these returns happened towards the end of the year, when the Federal Reserve looked like they were going to start lowering interest rates. So just a quick point on this. This is a chart I showed over the history of bonds. We just went through one of the worst the worst bond market of all time. And this is looking at 10-year Treasury bonds. But in 2021 and 2022, they were down 22%. The other four worst times, 2-year periods, 3-year periods, since the last 100 years, you can see that was only down 3.5, 4.7, 3.3, and 3.1. We just went through a drop in 2021 and 2022 of 22%. Every following year, they were up. And actually, if we could go out further in this and say, look, following few years, it tend to lean on the positive side. And on average, the next year was up 9.45%. So you can see after that bad time, bonds did eventually come up. They were up 3.8%. Those just Treasury bonds were, but I still think there's room for those to come up significantly over time. So jumping into kind of something that I don't think is going to necessarily affect short-term issues, but it could create a long-term problem, and that's our U.S. debt. And debt is different than a deficit. I'm showing you the deficits right here, but debt is caused when you have a lot of deficits. So basically, think about it from a personal budget standpoint. If you bring in $10,000 a month and you spend $12,000, then you have a $2,000 deficit. Okay, that's a negative cash flow, and that gets added to debt. So we're at our highest debt. I don't have a chart for this right now, but we're at our highest debt level as compared to GDP in U.S. history right now. And we've been spending our deficits. The U.S. budget deficit is significantly high. This gray line is taking the average deficit. And where there was too many zeros over here to kind of show you what it really was, but this is measuring trillions. So on an annual basis, on average, pre-pandemic, we were having deficits around 1 trillion. Post-pandemic, and during the pandemic, deficits of around 2 trillion a year. So it's really difficult because from a political standpoint, neither side wants to run on that because that means you have to cut something, whether it's defense or Social Security or Medicare entitlements. It's almost political suicide to run on this. So it's very difficult to anticipate these numbers are going to come down until people really feel the pain. And I'm not sure the pain's going to come just now. I still think we have some time before we feel the pain, but I'm just giving you a heads up over the long run. Unless we start to bring down the U.S. deficit, the more those deficits are and the more our debt grows, it just causes potential long-term problems for the U.S. and affect the world as well. So, all right, shifting to our kind of last section here. This is looking at the presidential cycle. And so the presidential cycle goes 4 years. So the first year of a president's term, second year, third year, 4 year. The best the best year of those presidential cycles, ironically, was last year. It was the third year of the president. And this doesn't matter if it's Democrat or Republican. This is all presidents. All right. The fourth year, which is election year, is the second best year. It's averages 6.17% return and is on average positive. Election years are on average positive. So I don't necessarily base our, where we invest specifically on that, but this is leading up to a point I'm trying to make here, which is if you look here at this left chart, if you were only invested, if you invested $1,000 in 1953 and you were only invested when a Republican president was in office, you'd be at 27,400 over that time period. If you only invested when a Democrat is president, you'd be at 52,000. It doesn't mean that the market, I'm not trying to make the point that the market performs better when a Democrat is in office. Democrats were in office for a longer period of time, so you got the effect of compounding. But really what I'm trying to make the point of is this next chart over here on the right, which is if you just stayed invested across all presidential cycles, you'd have 1.4 million versus if you only invested when a Democrat was in office, you'd have 52,000, or you only invested when a Republican was in office, you'd have 27,000. So which looks better? I mean, the point is obvious here, but, it's really important. And I know sometimes people get, really emotional around, if one president's in or another president's in, and I'm sure this year is going to be like that. But it's super important to stay invested regardless of who's elected, because who's elected does not drive markets. Markets are driven by other forces than the president of the U.S. And really should be watching the Federal Reserve much closer than the presidential election. It doesn't say I don't want a good candidate and I don't want good things for my country. I'm not trying to say that. I'm just trying to say the point that it's always best to stay invested, even during potentially volatile time periods like an election. When I say volatile, it's volatile emotionally. All right, so wrapping this up here, one thing that we do for our clients that is just, I wanted to point out before I kind of give our closing thoughts, just I think it's important for people to know this because they don't really see it much, but we're kind of going into tax time, is we do what's called tax loss harvesting. And I'm not going to get in exactly what that is. We have a blog over here that you can see that Ryan helped write. If you go to the allgenfinancial.com and go to our blog and just search tax loss harvesting, you can see that. And that explains exactly what that is. But, just kind of, these are general figures, not meant to be exact. But last year, we were able to harvest about $6.2 million in losses for our clients. Now, you're saying, Jason, that's not great. You cost 6.2 million in losses. No, it's not that. The accounts were up last year, and accounts had pretty good returns last year. It's that if you can sell when things are get down, simultaneously buy something else so you don't miss out on the bounce. But from a tax standpoint, for your non-retirement accounts, that makes a difference because you pay taxes based off of realized gains or losses, and you realize it by buying and then selling. When you sell, that's what realizes it. So we use an average of capital gains rates. So capital gains rates can go from 15% all the way up to almost 24%, but just using kind of halfway point there. General figures here, 20% capital gains rate. So we help save our clients potentially around $1.24 million using that by being able to match up those, not having to pay those capital gains, but being able to match those up against match those losses up against gains to reduce taxes. And so you don't see that as much in your returns. However, your net return after taxes, what you end up keeping at the end of the day, it really helped our clients. And this is something we've invested a lot in new software that really helps us find these different opportunities while still kind of maintaining the portfolio's allocation. But that's something that we've been focusing on a lot over the last few years. And as you kind of go into tax season, just make sure, because we did a lot of this in 2022, that you let your accountant know, hey, I just want to make sure you're kind of carrying forward those losses because you can use those for future years. And when times are bad, that can be something that can help you for future years. And we've done a lot of that. So I'll let you watch that video to kind of learn more about that. And to wrap things up, just kind of summarize before we kick it back to Paul here. We think, the valuations for large growth stocks aren't as attractive as they once were, but small caps are looking a little bit better from a valuation standpoint, and international stocks are also. That being said, there's still trillions of dollars in money markets that could provide fuel for market growth. So even though things are overvalued, they can get more overvalued because you have some fuel there. But at some point, we have to make sure and maintain a good diversification and not just be in stocks that are overvalued, trying to catch that last little rise before it takes a really big hit. So delinquencies are starting to rise, which is a risk, a kind of an early red flag. And then we do expect, because of the difference between what the market expects the Fed to do and what the Fed's saying they're going to do, to cause a little bit of bond volatility. However, they are paying much higher rates, and so we still think they're attractive. And inflation is trending in the right direction, but it's still a risk. If the economy stays strong and inflation doesn't come down, that could cause a risk because the Fed wouldn't lower rates, and the market really wants to see that. So, we mentioned this in October of last year, and it was an even better time then. We still think it's a good time. If you have extra cash above and beyond your emergency reserves, don't tap into your emergency reserves. You have to maintain those. But just cash that you were scared about the market, you built up, and now would be a good time. October was even better, but now still to continue to redeploy that, because you want to try to get better returns over the long run than what money markets can provide. And even when money markets are like a little over 5% right now, as interest rates come down, and if you look at long-term returns of money markets, they're really around 1.5% over the last 20 years. So, and if you wait for money market rates to come down before you invest, you could potentially miss out. So with that, I'll turn it over to Paul. Take it away, Paul.
Yes, thank you. Obviously, that's a lot of information. So thank you, Jason, for that. And as mentioned earlier, please feel free to add questions. I know some questions have come in already. We'll get to them in a second here. So I'm going to go quickly because I know that was an extensive presentation, but it's the first of the year and there was a lot to cover. So as you guys keep typing in any additional questions, I want to quickly bring to your attention a couple of things. In addition to these webinars, we have other resources available to you. So we have our blogs that we post. For example, we've got the blog that came out in January by our resident CFP, Ana Fernandez, January's Financial Wellness Month and considerations, and why in the new year so many people consider different financial issues and for themselves do some planning, etc., which is what we're big on. Let's do some planning for the year and set some goals, etc. So there's also the blogs on our website, but in addition to that, there's videos. We have a YouTube channel. So we always suggest and recommend that feel free to subscribe to the YouTube channel. We put out a video last year called Hack Your Retirement, Maximizing Your Retirement Planning with Roth Conversions. So Jason and I or other members of the team will go in there and update these, once a month or a few times a month, depending on current topics, etc. So again, in the chat, we have a couple of links for you where you can actually read transfer over to read the blog on tax loss harvesting that we put out last year, or just go to the YouTube channel to subscribe. So those additional resources for those of you that like to stay informed on the latest and greatest of what AllGen is putting out there. Very timely information right now is also, as we're in the first quarter of the year, there's some deadlines. So we give our financial planning update. There's some deadlines that are coming up. Obviously, the big one is taxes, right? First quarter, leading into the second quarter is tax deadline if you don't file an extension. So the deadline for filing business returns is March 15th. Okay, which is the same every year. Personal filing deadline is April 15th for your personal tax return. Again, barring extensions, which take you into October and November timeframe, September and October timeframes. Okay. There is still the ability, we talked about tax loss harvesting, and as we do planning, we're very big on saving you taxes. One thing is what your portfolio is doing. Okay. The other consideration is how am I optimizing my financial picture as a whole, and one of them is minimizing my taxes legally, of course, but are there any tax deductions, tax strategies? So that's our tax planning that we do with our clients when we do financial planning for them. So there's still one of them right now is still the ability to establish a company retirement plan. Traditionally, the SEP has been the one that you can extend into the following year, so you can still establish a SEP and take it and deposit money this year, but get a deduction for last year's taxes. Something to look at. I'm not necessarily recommending that yet, because if you have debt, etc. So this is where your financial plan would, dictate what you should do on that front. There's also the ability with legislation that came out a couple of years ago to actually still establish a 401k plan for your company. Okay, you would miss out on the employee deduction part because that's payroll driven. So you would have had to contribute that part by, held that part by the end of December, but you can still contribute the employer portion of a retirement plan this year if your company qualifies to make that, if it makes sense to make that happen. So, of course, we always say, call us, speak to your financial advisor to see if that makes sense for you. And then also another planning update is this next month, actually, in a few weeks, the Florida prepaid plan opens for those that are interested with the new updated rates. It might or may not make sense for you. There's different options, but there is a small window, a couple of months, to be able to enroll your child in the Florida prepaid if that does make sense for you according to your financial plan. Okay, so that being the case, we want to go ahead and open up and address some of the questions that we had. Feel free to, as I spit these out in the next few minutes before we wrap up, and add some more questions as you see fit. So one question, which was interesting, thank you, Cheryl, for that question. Isn't the fourth quarter the Santa Claus effect, Jason, on the market? What's your perspective on that? Obviously, knowing retrospectively what just happened, knowing what we said happens in elections year, what are your thoughts on that?
Yeah, I mean, I think that does have something to do with it. I think the really big drive, though, and just for those who don't know, the Santa Claus effect is just historically markets have done really well in November and December after coming off of kind of their weaker time frames of kind of September, October. That does have a little bit to do with kind of those historic cyclical effect. However, I think the big kind of swing as we went into that time frame was a shift in inflation numbers coming up a lot less inflationary during that time, which caused a lot of the market to think that, okay, interest rates are going to stop going up and they're actually going to start coming down, and then they come down at a faster rate. And then some of the job numbers not being are being weaker, which would be good from the standpoint of not having to keep interest rates high. And that really kind of sparked the market to really go into that, kind of, if you want to call it Santa Claus rally of Christmas time, and people buying a lot of, it's a big consumption country, big consumer driven country, and we tend to buy a lot of stuff around Christmas times for gifts. That being said, going into 2024, back to the jobs numbers, jobs numbers, unemployment numbers, things that have to do with jobs are looking a little bit stronger, more inflationary than kind of where they were October through December timeframe. So that has caused some of the expectations for where interest rates to come up a little bit, which has driven bonds down a little bit at the beginning of the year. So something that we're we're watching closely, like I said, going in further into 2024 with how the jobs market plays out.
Very good. Thank you. Next question. Would this be a good time to put some of my emergency reserves in certificates of deposit? And I'll tie that with a second question, which is, I guess, it's trying to lock in some of those higher rates. Or if I'm in retirement, should I use some of my portfolio to lock in some of the higher interest rates on bonds right now?
Yeah, so I know that has been a very common question recently. The issue first of all, it depends on your financial scenario, right? There are some people, especially businesses, where it makes sense to manage cash reserves. And if you're managing cash reserves for a business, and this is something we do help some clients with, then yeah, you could do a CD ladder and get pretty good rates, kind of lock those in for a longer period of time. But for kind of the average investor, right now, I don't think would be a good time to lock in these rates, because CDs typically you only buy them a couple years out, and what can happen is, yeah, you'll get a good rate for the next couple of years, but when it comes due to renew that CD, rates will probably be lower at that time. And if that did play out, you remember bonds go up as interest rates go down, and the market typically tends to do well as interest rates come down. So you would have missed out on market returns. So, for people's emergency reserves, we like to have those in money markets to keep them liquid, but still try to get the higher returns. But additional monies to put those into the market and take advantage of what could be an interest rate time period that is coming down, which is typically good, especially for bonds.
Very good. One last question that we'll throw out here that was put there is, do you have any concerns about the rumors concerning taxing unrealized gains? Jason, I don't know if you want to address this. I can address it however you like.
Yeah, we can maybe tag team it, but I don't right now. I don't think that would get passed. But if kind of flipping back to that chart where I pointed out kind of long-term deficits and long-term debt, if you get to if you get to a time period where our country has so much debt and the deficits are so high, where that becomes a significant financial burden to the U.S., then it starts to become somewhat of a game of what we could tax. This doesn't answer the question exactly, but it still stays in the tax subject. Is that one thing that is a little bit more relevancy, I think, in the short term, is the sunset of the current tax rate, the Trump tax rates that came in, I think, in 2017. Those sunset at the end of 2025. So that could, the election could have an effect on that. But at the same time, that still has to be passed through, Congress. But that is more of a shorter term effect, where I think we can kind of watch to see, what that does to income tax rates, and if they do try to raise corporate tax rates back to kind of the levels they were before.
Yeah, so it's wait and see, although we're not concerned about it to address the question, not yet anyway. And last question, if not CDs, how about 10-year T-bills?
Yeah, treasury bills, just 10-year bonds. You could buy those right now and get about 4. You kind of lock in that 4.1, 4.2% is what they're paying right now, and lock that in for a 10-year period. The thing with that is, first, we do have those in our portfolio. So a bond portfolio would include, quite a bit of those 10-year kind of government bonds, and even sometimes longer term when it makes sense, 20+ year government bonds. So I just think if you try to do that with just one security, you're trying to lock in just this one area of the market to get that 4.1% or 4.2% for the next 10 years. But there's so many things that can happen during that time, and you're kind of locking yourself into a scenario where if interest rates, do come down, you could have probably done better in a diversified bond portfolio. But at the same time, if you really needed that money and you were putting that money in to be more conservative, and interest rates went up, that treasury bond or that T-bill is down. It's actually, I think, a treasury bond for 10-year, but that's down significantly if interest rates go up. Okay, so and even though if you hold it to maturity, it'll come back to par value. If that's money you're depending on, and that's not money that you get nervous if you see it go down, you're going to have that effect. People sometimes think, well, what if they think if I put this money in a treasury bond, lock in that yield, I'll be fine. But what happens if interest rates go up to 10%, and now that bond, let's say that you put $100,000 in those 10-year U.S. government bonds, now those are down and only worth 60 or 70,000. Are you going to be okay with that? Are you going to be able to hang in there? And what if you needed that money at that time, and you had to pull out? So, I like to stay diversified in being able to stay nimble in case interest rates go up or going down, and not kind of locking myself into just one individual bond.
A lot of factors there. It depends on your portfolio, your emergency reserves, your need for liquidity, your tolerance to be able to see an account moving up and down. So, I'm going to end this by saying, at the end of the day, what does your financial plan look like? And I'm obviously biased as I head the financial planning department here at AllGen, but that's really what should be driving these decisions, and let the portfolio support your goals and your financial planning outlook. So, please feel free to call us, to reach out to your financial advisor if you think it's a good time for a review. We always think it's a great time for a review. And we wish you an amazing 2024. And thank you so much for listening. Have a great year.
Bye, everyone.
Bye.